Great honor to have Endeavor here. We certainly appreciate their willingness and openness to have us here at the headquarters too. So a big thank you. Dave Barge, thank you very much for connecting this, but also did want to introduce Brian Randecker, who is the CFO of Refining. Before he gets up and presents in regards to Endeavor, just to give you just a little bit of the groundwork and the rules here for this particular event. Presentation is going to run roughly 45 minutes to an hour. We will also have a section for Q&A. We want to be mindful of time for everyone here involved, so we will have a hard stop at 5:30. Do want to send my appreciation to everyone here who has showed up here in person, but glad everyone else is on the webinar. In regards to Q&A, we're going to switch this up a little bit. I'm going to allow the students to ask a question. So teams that have qualified and submitted your questions in time, I do have those in front of me. So we do have an honor code system that's here. You can ask those questions. So we will have a few questions here first for the teams who joined here in person, and then we'll follow up with the teams that are online. So in that chat section for the teams, please submit your questions there, and we will use those as questions. So let's go ahead and begin. Just because of time, we're about 5 minutes past. So everyone, this is Brian Randecker, the CFO of Refining. Thanks, Brian.
Thank you.
Control the presentation, or you want me to do it?
I can do it if you want.
It's up to you. That should just
see.
Let's find where the mouse is. Hang on just a second. Yeah. Zoink, and then you should just be able to, there we go,
The wheel will work.
Wheel.
Perfect. So before I start, I'll give you kind of a little background on myself and a little background on this presentation. So I've been with the company about 12 years. I've held a variety of roles within the company. Currently CFO of Refining, so I manage all of the OPEX, CAPEX, financial analysis for all of refining. So on an annual basis, it's probably right around $3 billion worth of costs that I'm responsible for to make sure we hit from a budget perspective. Prior to this, I was the head of investor relations, which is the function that deals with Wall Street, equity analysts, research, and dealing with, quarterly earnings, the Qs and the Ks. I've written most of the K, so fully aware of what goes on there, but also held roles in finance, treasury, credit, strategy, and M&A. I've been part of the IPO of our logistics business, just about every acquisition we've had over the last decade. And in a prior life, I was a banker. So it's this company's been a fun one to work for. It's constantly growing. About this presentation. So every year, the company goes to New York, and we present to our top shareholders and our top investors. And we give it's called an Investor and Analyst Day, and we lay out what we're going to deliver over the next couple of years. And we then look back and say, here's what we told you last year, here's how we did, and here's what we're going to be doing going forward. So this presentation was given to that group of individuals on December 5th. It's on our website. There's several videos that go along with it and clips. The actual presentation was 2 hours, and then we had over an hour of Q&A. So we're going to do it much quicker today. I won't hit every slide, but we'll hit the highlights for you guys since you're going to be valuing the company and looking out into the future. And along the way, I'll kind of give you some highlights from a valuation standpoint and what to look at as we execute our growth and what this company is all about. So I'll actually start on slide 5, which if you guys when you've done your research on Endeavor, you'll realize that the name and ticker symbol has not been around that long. We actually changed the name of the company August 1st. We changed it from Tesoro to Endeavor. The reason for that is, we had just gone through a major acquisition. We don't, The name of the company, yeah, it's a brand, but it's not a brand we utilize for the end consumer. So it's one of those that we did it for our internal employees to make sure that we have one culture and we're all doing the same thing, because this company is a company that acquires things. Just about every year since I've been here, we've acquired something. So I think we've been part of probably close to $20 billion worth of acquisitions over the last decade, and there's no sign that that's going to stop as we move forward. And so with that, the reason for Endeavor is so we have actually the Endeavor way, or a culture where that is the way we do it. Because today it's a amalgamation of, well, that's the way BP or Shell or Amoco or whatever refinery or organization owned us before. It's kind of a what is best in class. But we're now large enough that we can create our own company, own culture, and that's part of the CEO's vision.
Okay.
So,
can we give him video?
How we do stuff. It's actually fairly interesting, but if you want to see more about this, listen to the CEO give it. He'll do it a lot better than I can give him credit. So listen to the actual webcast. So as David talked about, safety, the environment, health of our employees is actually a very important thing, as you can tell by it's slide 3 of the presentation. The one thing you guys need to realize from the investor relations perspective and the analyst perspective, this is becoming a bigger and bigger concern. We get letters from top shareholders out of Boston, and everyone in Europe, but it's starting to come to the U.S. now, where they want to see this stuff. They want to know, what are you doing from a health and safety perspective? What are your OSHA recordable rates, safety rates? How are you impacting the environment? And do you actually have a plan to improve the environment? We received probably 6 or 7 letters last year from investors about this, and we actually got some nice compliments when we went to Boston after the meeting, that we were the first company of the 50 letters they had sent out that actually put it at the front of their presentation, talked about it, and is taking it seriously from our industry. Because when you're talking about a carbon footprint, we sell hydrocarbons. That's a very hard thing for us to get away from, but it is a big deal when we look at air emissions and how we're impacting the environment. So it doesn't hit the financials, but as you look at companies, it's something you need to be aware of, because that can impact the value of a company just as much as net income sometimes, if they're doing the wrong thing to the environment, and the investors and press take a hold of it. So one of the things that we within operations talk about is that we operate at the will of the community. So that really means that we have to be good corporate citizens, we have to be good neighbors, and if we're not, they can shut us down. So the health and safety and the governance aspect is almost as important as your financial balance sheet. So it's just something that, everything we do starts with safety, and it's something we always talk about. And most everybody within the industry will also talk about it. So from a competitive position, we have 10 refineries, 1.2 million barrels of capacity, refining capacity on a daily basis. Our footprint is a little bit different than our competitors within the industry. So the major refining corridors in the U.S. are on the Gulf Coast. There's 17 million barrels of total refining capacity in the U.S. Half of that is on the Gulf Coast, and we have 0 barrels of capacity on the Gulf Coast. We look for niche markets and markets that are slightly more isolated from a competitive position, where we can be the best operator within that market. Within this industry, the product that we refine and the product that we sell is typically sold very close to the refineries. If you transport it probably more than 150 miles, you're not making money. So location has a big impact on what we do. And then we also look from a value, we call it value chain, and we like to be integrated. So all the way from wherever we buy the crude to wherever we sell the finished product, whether that's 90% of what we sell is gasoline, diesel, and jet fuel. The rest are kind of byproducts, coke and light ends, natural gas, or not natural gas, but butanes and isobutanes and LPGs. So the markets we're in most of the markets we feel the best asset within that market. We have a variety of brands, as you can see, that we market. So most people, when they buy from us, they don't know it's us. They may think that's a very strange business model, but we're the largest Shell dealer in the U.S., and we're quickly becoming the largest ExxonMobil dealer in the U.S. But they have large brands that are known worldwide. They have advertising campaigns, and for us to use their brand, it's a fraction of for every gallon we sell, it's a fraction of a penny that we pay, and we get a premium price for their product, or for the product that we make and we sell, and we just put their additive in. And the additives it's a immaterial amount in the amount you sell in those big trucks that you see on the road taking the gas to the gas station. It's about a thimble amount in every truck for the additive. That's what makes the gas different from one station to the other. So you may get a molecule of it or not in the tank you buy. So the next thing is the culture here is really about delivering results and execution. I think this is a good place for us to probably spend a couple minutes on. We talked about refining capacity. Store count is the second one. So this is the number of retail stations that we have, so that are branded, or we call them branded stations. So stations that fly our flag or fly one of the brands that we carry. That could be a Shell, an Exxon, an Arco, a Tesoro. I think in total we have about 12 different brands that we can offer the consumer. But we look at, when we go and talk to any individual business owner that owns the store, we look at the site, we look at them, and we offer them the best brand that'll get the most traffic through the store. So we have a big variety of brands. We kind of break them into value brands, which are discount, and then premium brands, which are going to sell the fuel at the highest margin. And those are the big national brands, the Shells and the ExxonMobils. So retail branded marketing integration. So we have, for the primary products we sell, we have contracted volumes for about 95 to 100% of our capacity. So our refineries produce any given day, about 1.2 million barrels of clean products, and we sell that, and we're contracted for about 95% of that sales every day. So if we go down for a turnaround, we have to buy in the turnaround is maintenance. So I'm not sure how familiar you guys are with the industry, but from a refining perspective, our refineries run 24 hours a day, 7 days a week, 365 days a year. And to give you an example, the refinery up in Mandan just went through major maintenance this year, and we took it down for the first time in 7 years. They run continuously beyond that. Most of the units can run from anywhere between 3 to 7 or 8 years before we have to take them down and do maintenance on them. But our retail branded integration is the amount that we actually sell through a branded channel, where it's not like a wholesale sale of product. So the goal is to continue to increase this. As you can see, we've taken it from 23 to 51% of our total gasoline sales, and we're going to continue to try to keep increasing that amount because we get better margin on those sales. OSHA recordable, that's a safety metric. We're top quartile within the industry. There is a high correlation between safety and profitability, because if you're safe, you don't have injuries and there's not issues with your equipment, and therefore you're running and operating and your throughput and utilization is very high. So this is an industry where safety does matter, and we try to, the injuries we're having now are all over the board, but it's one of those that with what we do, it's high temperature, high pressure, and we deal with flammable substances on a daily basis. So given that combination, there are accidents that happen, hopefully, and thankfully, most of the stuff that happens are cuts and bruises. Enterprise value, I think you guys know what that one is, but since 2010, we've seen a slight increase in our enterprise value from a corporate perspective, and we're probably one of the best performing energy stocks over that time. And I don't know where we stand today, but over that time period, probably one of the best stocks within the S&P 500, or at least probably top 25. We've gone from about $8 a share to $111 a share. And then we also have another, our MLP. So if you guys aren't familiar with MLPs, the limited partner structure, infrastructure, logistics assets, we've IPO'd it back in 2011, and it's now a $14 billion entity. And it continues to acquire things as we move along. So skip that one. So when you look at us and some of the peers, the one thing that you probably will realize is we're one of the few that actually puts out EBITDA targets. You may question that because most of the companies you've probably researched, it's very easy. You take revenues and put a growth rate on it, and you'll be able to figure out what kind of net income they'll have. That's not us. I've in charge of one of the largest segments and look at our P&L all the time, ran investor relations, and I'm not sure I could tell you our revenues last year within $5 billion because they don't matter. We can make just as much money if our revenues were 20 billion as if they were 50 billion. We're a slightly unique industry in the fact that it's all based on a margin. So we buy a commodity, which is crude oil, and we sell a commodity, which is gasoline and diesel and jet fuel. There's no difference in our product on what the people next door sell. We just have to have it in the right place and manufacture it at a lower cost. Economies of scale matter. So the way we talk to the street and the way we tell people how we're going to improve our business is a little bit different than most other industries. We say, hey, if the market is the same, so the margin, or we call it the crack spread, which is the difference between the price of gasoline and the price of crude oil. And there's a formula. It's the Gulf Coast 321 is probably the most common, but you guys can do some research on that and learn about it. But we say, assuming all variables stay the same, and we do all of our improvements, we acquire, deliver the synergies, what we're going to talk about, we're going to grow earnings from 2017 of 3.1 billion, and in 2020, based on the projects and everything we have, we're going to grow it to $4.5 billion. And we're going to do that in a couple different ways. The first is Western Refining. So in June of 2017, we closed the acquisition of Western Refining. It was 3 refineries located in El Paso, Gallup, and Minnesota, and a couple hundred retail stations, a MLP that we've since combined and merged into Endeavor Logistics. And we told the street, hey, we're going to deliver $400 million in synergies. Synergies can come from cost savings, operational efficiencies, and just getting a better value on the products that we sell. And we'll go through those. Strategic capital projects, we have 3 capital projects that are about to complete over the next 18 to 24 months that should grow earnings by about $175 million a year. Our marketing business is going to grow. We're going to add more stores. We're going back to a convenience store model, but we're going to increase earnings in marketing by about $300 million. Logistics, it's pretty easy. Logistics is all valued based off EBITDA. It's a very steady state business. So we're going to grow the EBITDA within Endeavor Logistics from about $1 billion to $1.4 to $1.5 billion over the next 3 years. And then refining, $175 million. That's really just a full year run rate of the assets that we bought that we closed mid-year this year. So the refinery should make about another $175 million versus what we did this year. So we very clearly lay out to the street how we're going to grow earnings. The one thing I'll tell you is, for every dollar in margin that the crack spread or the index moves, it's worth about $400 million in EBITDA to us. So the margin that's available, which is, it's a commodity-based, it's a market that sets the price for gasoline and diesel and jet fuel, which is out of our control. We can't, we're market takers because our product is a true commodity. A dollar change is very meaningful and can dwarf a lot of the improvements we're doing. But over time, the market is fairly stable. You'll see big blowouts, you'll see margins go through the floor, but over time, it goes back to the average. The other thing, from a capital perspective, we're going to do it without actually spending a lot more capital than we have historically. So everything that we've done, we've either already acquired or is in the works. We've spent about half the capital on the major projects, so we don't have big capital expenditures or an increasing set of capital expenditures to go after to actually deliver $1.4 billion of EBITDA improvements over the next 3 years. So going to the next slide, I think this is really hitting the investors where we said, hey, versus our peers, we have better, cash flow CAGR, ROIC, we're actually delivering results. If you listen to the presentation, I think our CEO had a great quote in there that, if we're not actively doing something, we're falling behind. This industry is a very mature industry. There's lots of people out there that are talking about, what's going to happen with the impact of electric vehicles, fuel efficiency. Those are all things that as you look out 5 or 10 years, may erode the demand for our product. And as we go to the market outlook, I won't go through the different key prices, but one of the things that we talked about is, over time, we expect the gasoline demand and the demand for our products will be flat. On a probably best case scenario, over the near term, it's going to be flat, but over the next decade, it's probably down. We'll see, efficiencies in vehicles and EVs and whatever else is out there that will erode the demand for our product. So we need to be looking for how do we upgrade gasoline to more valuable products? How do we have ratable offtake in other areas? Are all things that we're thinking about of what happens if gasoline demand slips by 1 or 2%. How do we move that product somewhere else and make sure we stay highly competitive? The other aspect when you talked about this is our price deck that we use and the prices. It's not dependent upon crude oil going back to $80 or going down to $30. $50 is a very conservative estimate from a crude perspective, so it's one that we're not looking for the market to drag us to $4.5 billion. We're going to do that ourselves. So we have regional crude differentials, regional crack spreads, other key metrics, the Endeavor Index, and fuel margins. So these are two key things that we talk about. On our website, you'll find the Endeavor Index. When I talked about the Gulf Coast 321, that's a crack spread. The Endeavor Index is just looking at our assets and giving an approximation for what we could potentially earn if our refineries were running as they do on an average annual basis. So it's a proxy for our earnings. I always tell everybody that it's more of a, look from a weather perspective. If you have a barometer and a thermometer, a thermometer is very accurate. A barometer's goes the right, if it goes up, you know what to expect. If it goes down, you know what to expect. This is more closer to a barometer than a thermometer. It's one of those that it's directionally accurate. But as you can see, over the next couple of years, we expect it to be very similar to what it was in the past. 2015 was an anomaly. We had a peer on the West Coast that was out for about 12 months, ExxonMobil, and the margin spiked because supply was short. So your economics really come into play in this business because it's all about supply and demand. The markets that we operate in are fairly balanced, and are not long. But when somebody has an operational issue and has to shut down, the margins spike as a result of that, like they did when the hurricanes happened and gas runs out and all the refineries shut down. We can make a lot of money in those situations if we can supply the product when our competitors can't. Fuel margin is when we look at our retail stations, this is the average margin we make per gallon that we sell to the consumer. They buy the fuel either from the refining segment, or they buy it from third parties, so they can buy it from competitors. The other thing to think about that we did talk to people is in 2020 there's a big impact on fuel oil, which is a regulatory market, or it's a market. There's going to be a regulation change, and that impact, using third-party kind of estimates, could have a potential $2 to $2.5 billion increase in our EBITDA if that law actually comes into place and is fully complied with. Upon questions, we got that, it probably won't be fully complied with, but if we got 50% of that in 2020 as an upside to the $4.5 billion, that's probably where we're thinking. But it's we try not to look at regulatory impacts that are outside of our control, because we don't know what will happen. We don't know if the regulations will change, and we don't know the compliance, because this is a global regulation for marine fuel oil bunkering. It's IMO spec change that's going to happen. So flipping over to marketing, within marketing, we kind of lay out within each section what we're going to deliver. So we're going to increase our branded volumes, grow the stations. We're actually going to improve our convenience margin by growing. Historically, we've not operated our convenience stores. We've had a third party do that. We think we can do it better. And now that with the acquisition of Western that happened earlier this year, that's part of the synergies. And we're going to invest in store enhancements and focus on our brands, growing earnings by $300 million. We'll skip how marketing's grown since 2010, but driving branded fuel sales. When you look at this, within our segment, we sell about 12 billion gallons of fuel every year. That's split out probably about 47, 53% between unbranded and retail branded. So if you were to take those retail branded, and just to give you a heads up, this 2017 number is a pro forma for the full year if we would have owned Western for the full year. Off to the right, it actually shows you for every retail and branded gallon we sell, we make about 20 cents. And for every unbranded gallon we sell, we make 1.7 cents. So there's an incentive for us to brand the stores and move it from unbranded to branded. Unbranded, just so you guys know, would be like a Costco or an H-E-B down here that they fly their own flag. It's not a Shell or an Exxon or somebody else. So that's the difference between those. And we're really going to do that by, growing store count. So we're going to go from 3,200 stores to 4,000 stores, and we're going to spend some time and money upgrading our stores. We're going to spend about $150 million a year growing the stores, and going from 3,200 to 4,000. That seems very capital light if you think about it, to grow 800 stores. But when you have a branded model like we do, all you have to do is pay, somebody owns their own store, you pay them a fee of $100,000, $200,000, depending on the location. They sign a long-term contract, and then you give them all the signage, that pays for all the signage and, the kind of upgrade the site. And then you move and you have a increase in branded volume, and then you get a higher uplift on the gallons that you sell to those dealers. One of the other things that why we do from a retail perspective, when I talked about we have the Shell and Exxon Mobil, we actually get incentives from Shell and Exxon to grow their brands, and they actually cover part of that cost for us. So it's one of those, we can grow our retail branded stores in a very capital light, and our ROCE and marketing is through the roof compared to a lot of standalone people out there. We'll go from convenience store sales, as I said, we really want to grow it to about 25% of our total margin is coming from convenience store sales. This is actually a pretty easy thing for us to achieve, because as we convert what we call MSOs over to company operated stores, if we take what we have with the acquisition and what we're going to convert, we'll achieve this number once we do the conversion. And we're converting, we have 600 stores to convert, and we're going to do about 50 a quarter. Over the next couple of years, we'll convert all 600, and we'll achieve the convenience sales target. One of the reasons why we didn't operate our stores before is its economies of scale, that you get better purchasing power from, Coca-Cola's, the Frito-Lays of the world, if you're buying for 1,200 stores than if you're buying for 600. So we've kind of crossed that threshold that we'll get top tier pricing, and we'll see the average merchandise margin accordingly increase over the next couple of years as we're able to renegotiate all of those contracts and we start purchasing more product on a regular basis. We'll get the incentives to continue to grow that. So I'm going to talk about Mexico. There's a lot of people in the industry talking about opening stores in Mexico. Mexico had a renaissance in their energy. Well, they've opened up their energy markets. You can now operate in Mexico. Historically, it was owned and operated by Pemex, their national oil company. A couple of years ago, the president and government signed a bill that allowed competitors to actually come in. So you can now go into Mexico and you'll start seeing, the normal brands you see around the world. There was a big distrust that Pemex was not selling them the amount of product or the quality of product that they should be receiving. So in Western Mexico, we've opened up several stores. We're taking our product in, we're using a logistics system, and we're actually selling our barrels into Northwest Mexico. We're taking our Arco brand, which is a very popular brand in Southern California, and the goal is to send about 30,000 barrels a day of gasoline from the west coast of the United States to Mexico. To put it in perspective, 30,000 barrels, the total capacity on the west coast for gasoline production is about 1.6 million barrels. So 30,000 is approximately 2% of the total west coast production, can be moved very ratably out of our system into Mexico, and their margins there are highly competitive with ours, and it's an extension of our market. Historically, we've been exporting there already, but it's not been as ratable because it's been selling to Pemex, as Pemex decided whether they were going to buy from us or buy for our competitors. So this is a very ratable offtake that we're talking about. So summary of marketing, logistics. So this is from a logistics, next slide. From a logistics perspective, they're going to spend about $1 billion of capital every year to grow the business. That's going to come in about $500 million of organic capital and $500 million from drop downs. So within our refining system, we have assets that we can sell to the logistics company and monetize, and the logistics company will go out and they'll finance those asset purchases from us, but then they'll also spend about $500 million of their own cash to grow their business. They're going to do that by growing in the Permian, which is out West Texas, New Mexico, and then up in the Bakken, which is in North Dakota, where we take, and within the Permian, we touch about 25% to a third of the barrels that are produced out there, and within the Bakken, a very similar amount, about a third of the barrels that are produced in the Bakken are touched or consumed by our system. So we have very good logistics systems in both of those basins. And then we focus from a logistics perspective on third-party business. We like about 50% of our revenues to come from third parties, because why would you want to pay yourself and then pay distributions? But if we get other people's money by providing them services, it's actually a net benefit for the company, and we're growing our business. So we talked about $1 billion a year from acquisitions. This kind of gives a historical perspective of what we're doing and organic projects and drop downs over the next couple of years. We have a very significant organic project portfolio that we've laid out for the market, where over the next, that we'll be able to deliver that $500 million of growth from organic projects over the next 4 years, given these projects. So the ones in blue, Conan Crude and the LA Interconnect, are both under construction today. LA Interconnect will be done late next year, and Conan Crude Gathering will be done mid next year. And then they're being done at the parent level, and then they will be dropped down at cost plus interest to the MLP. They're large projects for the MLP to do, so you don't want to have the negative carry. We also talked about the drop-down portfolio. So over the next, we have $700 million of EBITDA that we can drop down to logistics. We'll do $40 to $50 million a year, generating $400 to $500 million of cash for the parent. And from a financing perspective, any financing that we give some talking points in here, but it's about a 50-50 financing mix between debt and equity, as the logistics company funds itself. We kind of give you the walk from a logistics perspective of how we're going to go from $1 billion to $1.5 billion of EBITDA over the next couple of years, the different projects, and how we're going to deliver those. I'll probably skip a lot of the, if you guys have questions about the Permian or Conan or Delaware, Bakken, you surely can ask those later. In the sake of time, we're not going to go over them. So, okay, yeah. From a refining system perspective, I'm going to deliver $175 million of capital projects. We'll go over those in a minute. And we're going to capture from the synergies that we talked about $200 million from the Western refining synergies. So yeah, we're on page 47 now. So, and we're going to do that by focusing on business improvement, operations excellence, and just creating value within our system. So, some major capital projects. So the ones on here that are in blue, or light blue, the Anacortes isomerization, LA integration, and EP Energy JV are the three projects that we're going to talk about. In total, they'll deliver $175 million of EBITDA by 2020. They're in total, the capital that we'll deploy for these is about $850 million. We started spending on them over the last couple of years, so about half of it left to go. A big chunk will be paid out in 2018 as we complete the Conan or the LA integration and the Anacortes ISOM project next year. The Lyric project is a $500 million project. We acquired a refinery in LA back in 2013. The project allows, we had an adjacent facility. It allows us to connect the two facilities. We're going to run a major pipeline between them. It's actually fairly interesting. If you guys go online, there's a video of it. It's like a 48-inch pipeline with a dozen pipes running through it. We went buried under two major freeways within LA because our properties share a fence line, but there's freeways between them. So it's a really neat project that is allowing us to shut down an FCC at, we'll talk about that. It allows us to shut down an FCC, and then within the commercial section next, we'll talk about it really allows us to flex gasoline and diesel production or distillate production. Distillate is diesel and jet fuel. So we'll be able to swing about 30 to 40,000 barrels of gasoline production to distillate production. So the West Coast is short jet fuel. We have to import jet fuel from Asia. And then diesel is a commodity that you can actually sell all over the world, and it's easily transportable. And we actually think from a longer term perspective, the demand for diesel will increase just given the economy, and diesel is used to move goods and services around the country. So the ISOM project is going to come online. It's a cost cutting. It allows us to comply with regulations, but it lowers our operating costs for the business while delivering more octane. Octane is, when you're at the gas pump and you see there's 3 different types, 87, 91, and 93, that's octane. So if we're able to increase octane production, we're able to make more premium gasoline, which sells at a higher value. We'll talk about Western refining synergies between this and commercial. These are the operational synergies that we'll be able to deliver between the businesses. When you look at it, these are hard to show up. I mean, they show up in gross margin, they show up in lower costs, they show up in efficiencies, they show up in lower turnaround costs or maintenance costs. So they show up all across the board, and but some of them we're going to make a higher margin on some of the products we sell. We're going to send them to different markets or move products around so we can create the most revenue possible for the company. Because with the different assets, you're able to move the molecules in different ways. And there's several good examples of what these are if you really want to know on the presentation that they gave last week. Reliability and utilization. This is really what matters. Our assets are available to run. From a utilization perspective, this is if you take our capacity times utilization and the margin, gives you a pretty good estimate of what the gross margin should be. But this is a game of numbers and running, that a 1% change in utilization is a pretty big thing when you start talking about 1.2 million barrels throughout the year. Kind of best in class is 97%, and that is very, very difficult to achieve given all just the different units and the different markets that we serve. Some of the markets in Alaska, you have to the market's not there to sell the product in the winter, so you have to run slower. You can't run at full capacity. So it's very, very hard to achieve that 97%. When we look at cost structure, as I said, my job is really thinking about OPEX. When we talk $2 billion of operating costs every year, which maybe on that one, our goal is to actually keep OPEX flat. We offset all inflationary pressures by efficiencies, headcount reductions, lower maintenance costs, because you have to remain competitive. You have to use technology, be more efficient. But energy does fluctuate that, but from an operating cost where we have control, we keep it flat. So about a third of our operating costs are labor, a third is energy, and a third is maintenance. And all of our plants except one are union, and they all see 3.5% annual wage inflation based on the union contracts. So we have to find ways to offset that third, and because that third automatically increases, so we have to offset it in the other segments. So we talk about within refining, turnaround spend and capital spend, or sustaining capital spend. So the sustaining capital spend on here, you'd say it's about $500 million, but this includes some regulatory spend over the next couple of years. There's some Tier 3 regulations, which is part of RFS. Our normal sustaining capital beyond this, if you were to look beyond 2020, should be somewhere between $400 and $425 million annually. So there's $50 to $100 million of regulatory capital that we'll spend in the next 3 years, but after that it's 400 to 425. Turnaround spends, this is the maintenance where I said we take the refineries down every couple of years. We spend $40 $450 to $500 million a year on average on turnarounds. The next couple years, or the next 2 years, are a little bit heavy, followed by 2020, where we think we've optimized it because of the IMO potential, where we want to be running and we don't want to be taking turnarounds, because you don't make any product when you actually take a turnaround, because all of your units are off. So that's how refining's going to do it. So value chain, we won't spend too much time on this, but we really look at our markets where we operate as kind of an integrated portfolio. So the entire West Coast up and down, we supply all the way from Alaska all the way down into Northwest Mexico is one market. We have 4 refineries that we optimize via ships that we move product around. The northern tier from Anacortes all the way over to St. Paul, we move crude back and forth and products back and forth. And then the big triangle from El Paso to LA and Salt Lake City, with Vegas and Phoenix and Albuquerque in the middle, you can move product back and forth to optimize, and then down into Mexico, optimize where the product is going to maximize your revenues. So, and then you're able to work the refineries together to minimize impacts from downtime or planned maintenance. A little bit about the types of crudes we run, the feedstocks. We acquire crude from all over the world. A couple different types of crude, but that's probably not something we need to talk about. We talked about the LA integration project, which on 63 allows us to flex 30 to 40,000 barrels of gas into distillate. Western synergies, distribution cost specialty. These 3 slides on, we always look at distribution costs. We spend $1.5 billion, $2 billion a year on distribution costs. So it's one of those, it's a big moving products around the world, and crude around the world is very costly. So you try to minimize it. And this specialty business and renewables are beyond 2020. We're looking to grow those businesses probably out into maybe $100 million EBITDA businesses a year, but that's beyond our outlook that we talked to analysts for. But we started you don't want to surprise them in a year or two, so we kind of put that out there as teasers for them. So from a capital allocation financial principles, we just achieved investment grade here with both companies this year. That was a big achievement, something we had been looking to achieve for a long time. Allows us to extend the maturities on our bonds and lower our cost of capital through lower interest payments. We run a very disciplined financial business. We are opportunistic from an acquisition standpoint, so we always want to be ready for the next acquisition when it may come available, and not over-lever ourselves, because once you complete that one, there's probably another one that's right out there that you're going to go look at. So we always do everything from a very disciplined approach, and we try not to, because it is a very cyclical business. Margins and highly correlated to the economy. So if the economy is doing well, unemployment's down, our business should run at a fairly even pace, and we should make pretty good money. If there's a downturn in the economy, unemployment spikes, demand for our product, because most people drive their cars to go to work. And if they don't go to work, they don't drive, and therefore demand goes down. Supply and demand says we're going to make less money in that scenario. So we talk about the synergies. We really, to give you guys this, probably a good page for you on page 72. This is our key financial principles and capital allocation. Liquidity, we always like $3 to $4 billion of liquidity within the parent company, and about $1 billion to $2 billion of liquidity within the MLP. From a cash perspective, the parent usually has about $1 billion in cash. That fluctuates based on what we're doing, but we always look to have ample liquidity for whatever we need. Strong balance sheet, debt to EBITDA less than 2, and debt to EBITDA for the MLP of less than 4. So we look at leverage separately between the two entities. We also look at it combined, but we don't put targets out there for the combined because both entities have to stand on themselves and have their own ratings. but we do manage them separately and together. You have seen us, if you've looked over the last few weeks, we are extending the duration on our bonds. We've hit the market a couple times. We will continue to do that as the opportunities arise for us to refinance our debt and lower our interest costs. So anything that we can call, we will call, and anything, once it becomes callable, we'll take it out. Because I think we're going from an average duration of like 4 years to the goal is 12 to 15. Hurdle rates for investments within refining, 20% IRR, 15% for marketing, and logistics is 12 to 15%. So from a returning cash to shareholders, we'll buy back about $700 million in shares this year. We have a dividend. If you look at our dividend versus the peers, we have the lowest dividend yield in the market. We grow the dividend commensurate with the company. We don't try to have a leading yield on a commodity stock. It doesn't make a lot of sense, but it's one of those, we're set up ourselves for, and if there's ever a downturn, we don't need to cut the dividend. From a modeling perspective, you could potentially grow the dividend, and within here, we've grown the dividend 10% a year annually going forward. And buybacks, we have a $1.4 billion share repurchase program that we say will complete by 2020. At the end of the year, it'll be $1.4 billion because we're going to buy back about $300 million in shares, or we've disclosed we're going to do that this quarter. So $1.4 billion left over the next couple of years. This is actually a unique slide that the analysts really like. We look at where all the cash flow that we've generated and how we've deployed it over the last 7 years. This is actually a very kind of different concept that we try to do for the industry versus the peers. Financial discipline, we talked about this, but you can run your own numbers on that one. Capital expenditures, we hit the refining, but this really is, when you look at capital between the two companies, just as you model the companies, remember, Endeavor, ANDV, is standalone from ANDX. ANDX funds itself, and we don't, so the cash flows are separate. So it's a different modeling exercise to make sure you model that correctly. You just have to assume that within their capital disclosure that they are funding that from debt and equity issuances. This one really shows how we're going to generate $8 to $10 billion of free cash flow over the next couple of years and how it's going to be deployed. We'll end up with $2 to $3 billion available cash, which when asked, and that's one of the Q&A that was out there, we might spend about a third on additional capital projects if they make sense, and the other 2/3 we'd return to shareholders if there wasn't other opportunities out there. So additional share repurchases. This really shows the capital funding plan for ANDX over the next 3 years. This is how we're going to achieve all of the capital requirements. There's about $200 million a year of public equity that may be needed in 19 and 20. We just issued a preferred issuance earlier this year. Depending if the MLP market does not get any better from an equity standpoint, there's a likelihood that public equity would go to a preferred issuance. But as of now, it's public equity, but we'll look at it when the time arises when we need that. Talk about investment grade, really doesn't, returning cash to shareholders. So we'll leave it at that. We'll go for Q&A from there.
Let's do that. All right, so we're right at an hour. So again, we can start with the Q&A for the teams who have submitted their questions in time. You can have 3 questions each team that has 1 question to ask here, and then we'll open it up to online questions. So teams who have submitted their questions, please feel free to ask those. And then for for the ones online, go ahead and type your questions in, and then we will, Dave, if you don't mind, just mentioning those.
Yeah, let's start in here first.
Yeah. Very intimidating environment. I certainly understand. Just have fun with it. Brian's been great to us, and he's happy. And so, if you don't mind, just mention your name, the school that you're representing, and then Brian, if you don't mind, just
restating the question. Okay.
My name is Andrew Troxler. I'm from the University of St. Thomas in Houston, and one of and any of the specific refineries owned by Randecker.
Okay, so are there any plans to increase light crude oil refining? Our CEO, I love when he gets asked questions about increasing capacity. His answer is, we do not need any more refining capacity within this country ever again. And we will not increase refining capacity, or we try not to. Every once in a while, when you do bottleneck stuff, you may increase your capacity, but we won't spend major capital to increase capacity. There is an excess and abundance of crude oil, the shale oil from the Bakken, the Permian that's out there. We're looking for ways to get crude oil from the mid-continent to the West Coast. We could take upwards of another 250,000 barrels of crude oil in the mid-continent to the West Coast if we could get it there. The problem is that there's a regulation. You can now export crude oil, as I'm sure you guys may be aware. If you move Permian or Eagle Ford crude to the Gulf Coast and you put it on a ship, you would think taking it to the West Coast or the East Coast would be the most logical option. But the U.S. has a regulation and a law called the Jones Act. And the Jones Act says that if you go from one U.S. port to another U.S. port, you have to use a American-made, American-flagged, and American crude vessel. And if you go from a U.S. port to a foreign port, you can use a foreign vessel. The rates on U.S. vessels are about 4 times as high as rates on domestic vessels. So they can load a vessel in the Gulf Coast and they can take it to Korea or Singapore or China for cheaper than we can take it to the West Coast of the United States. So we would love to get the crude. We're trying to get it there. But it makes more sense economically for us to go get crude from the Middle East. Or continue taking crude from the Middle East.
Ray Garza from Texas A&M University, Kingsville. And how are y'all going to implement the tax reform and the savings of, 20%?
So from a tax reform basis, we are a full taxpayer. We're a domestic entity. Our effective tax rate, if you look over the last couple of years, is 36 to 37%. Given the hopeful approvals that are going through Congress today, our effective tax rate may drop down to 20 to 21%, generating, given this plan of going to $4.5 billion, potentially another $400 to $500 million of free cash flow over the next annually over this plan. We got that question also during Analyst Day of what we would do. There's not been any capital projects that we've not had the cash flow to do that meet our return hurdles over the last couple of years. So that would be truly excess cash that we would look to either redeploy back to shareholders or delever, or continue to grow the company in whatever form may come around. So, but there's no specific. We wouldn't have a bunch of capital projects that we could go do.
So one more question here, and we can take it to online. Dave, are you getting questions online? Okay.
No, just got one. But
all right. We'll take one more here. Just go ahead and take it online.
UTA CFA, Austin probably, Since the industry is going through a consolidation phase, how do you evaluate the risk of being acquired yourself?
So as we go through, over the last probably 2 decades, the industry has been in a consolidation phase as the majors have sold off their assets or divested. Completely spun them off, like Marathon or Phillips PSX has. The one thing is that there's probably about 120 refineries in the U.S. today. That number continues to decline over time. We know all of the assets. We know all of the companies. We know all of our peers. And it's one of those that, we know what makes sense and doesn't make sense longer term. And we know, so you can look at our map. We know the assets that we want. The assets that are typically being sold are not great assets, especially if they're being sold by the majors today. They're ones that they've underinvested in or just aren't getting the return that they require. So we're very selective in what we buy. We think over the last couple of years we've bought great assets in Southern California from BP. The El Paso refinery, the St. Paul refinery are all top-notch refineries, and within their markets are probably either the number 1 or number 2 assets from a competitive position. So we're very selective in what we do. But when you look at our peers, I think we're much more nimble and competitive than they are from a strategic standpoint. So I'm not sure who would, we're always looking at different ways of whether you acquire them or they acquire you. It's a negotiation either way. So.
Kevin McGee from CFA and that goes. You said nimble. Can you elaborate on that?
Yeah. So from a nimble standpoint, it's very different because you think it's very mature industry, but there's actually been a lot of changes within the sector over the last 7 years with this shale oil revolution, and we've seen production rates in the Bakken go from 150,000 barrels a day to 1.1. The Permian, a couple 100,000 to a couple million. But it's one that you have to be. We're competing against not just our peers in this sector. You have venture capitalists, you have private equity that are going out and building things that have never, they may be guys that came out of the industry and they go get capital and they go build pipelines or they go build rail terminals. And if you have to be just as quick as they are, we are not a highly bureaucratic company. There's not a lot of red tape. If we look at some of the things we've done over the last couple of years, railing crude across the U.S. probably peaked out at probably a little less than 1 million barrels a day. We're doing less than probably 100,000 barrels a day today. But we're still railing 50,000 barrels a day to the west coast of the United States because we were the first ones to get our permit in, to get our space built, negotiated with BNSF before it really took off. And we've been able to drive the cost down. It's the most efficient. It's actually more efficient for us to rail crude to the west coast than it is for them to use a pipeline and ship it to the Gulf Coast. It costs about $6 on pipe and costs us about $5 to rail it to the west coast. So you have to be nimble and quick because you're not competing against oil companies, you're competing against private equity. And you can either do it yourself or you can buy it from them for multiples that no one really wants to pay, but they either connect into your system and make really good assets, and you don't want your competitor to buy it. So you'd rather be the nimble one that's out there making the deals and getting the connections.
I read something about the Tesoro terminal. You're building another big rail terminal. Is that correct? Is that not going to happen?
So there is a terminal. The question was a terminal in the Port of Vancouver, which is in between Washington and the city of Oregon. For the last 4 years, we've been looking to build a crude by rail facility there. The port actually originally asked us to come in and build the facility. The state of Washington had a 1-year process that any facility like this had to go through to get the permits to build the tanks. The environmentalists and other entities out there have extended that tremendously and put a lot of regulatory pressure, and ultimately the entity declined or does not recommend that we build it now, even though they originally asked us, the port asked us to do this. The governor still has the opportunity to approve or decline, and we'll evaluate our options at that point. But
Were there some costs with that? Did you put a lot into it already?
not anything material.
One question over here.
These seem like non-community questions at this point, so Patrick, see what you two say. Two questions. Your EV forecast is more aggressive than any I've seen. Do you expect similar margins on your biofuels? And secondly, what percentage of the rail terminals and rail cars are you using for home?
Okay, so from an EV perspective, I'm not really sure I gave a...
You saw projections within the next decade having material impacts. That's more aggressive.
Well, a material impact for us would be a decline. So if the economy stays strong and we see a decline in demand, that's either going to... We think if you look at the advances they're making on the internal combustion engine, on higher octane engines that are being designed out there, that will have a bigger impact than EVs. But the one thing that we're, I think of a lot of our competitors are going out and saying, EVs, that's, not our problem. We don't have to worry about it. We're probably the one company out there that's saying, whether it's the internal combustion engine or EVs, the chance of seeing a decline in gasoline demand over the next decade is probable. And so we need to be preparing for that. We don't need to be expanding capacity. We need to be looking at how do we upgrade gasoline to other products. We have a product that's a couple years out up in Anacortes, which is a mixed xylene unit, which is a petrochemical, which converts gasoline to gasoline blend stocks to petrochemicals. So we're one of the few that actually talks about it, but it's the investors care. And so we're trying to at least put some information out there and say, whether or not EVs penetrate the market, we think the RFS changes and engine technology we'll continue to see efficiency increases. And whether it comes from that or EVs, we're preparing to see a potential decline over the longer term in gasoline demand. And then your second question was on regulatory.
Your rail transportation.
Oh, rail, okay.
$6. I haven't seen a number on how many of the rail cars you actually own and how many you're paying.
We lease for almost all the rail cars.
Just real quick, just in case the folks online didn't hear, if you don't mind.
Okay, so the question was from a rail car perspective, do we lease or do we own the rail cars? And we lease the majority of our rail cars today. We're always looking at changes. There are some accounting changes over the near term from a lease standard perspective that come into play, I think, in 2019. And so we are starting the process of lease versus buy. That decision is going to become more important as all those leases will go onto your balance sheet either way. So you may see, and now that we're investment grade, we can probably lease cars, or we can probably potentially buy cars more efficiently. So you may see changes in buying patterns from companies, including us, over the next couple of years as those accounting changes are implemented.
Dave, any online?
Yeah, they've started coming now online. I may go slightly out of order of the online. One of the questions I think has already been answered about electric cars getting online. From Rice University, what is your preference between crude, heavy, light, sour, NGL, etc.? And is this the same question or is this a follow-up? How does flexibility and input impact your profitability and production, both currently and in the future? So I was thinking of those as one question.
Okay. Okay. So our input preference between the crude of heavy, light, sour, NGLs, and flexibility for our profitability, I'll tell you that all of the assets that we have, there's a term that we use, the metal is matched to the market. So the refinery production matches the market it sits within. So in Alaska, it's designed to take Alaska North Slope crude because that's the crude that's right there. And it's designed to maximize, from a yield perspective, jet fuel because, there's more plane traffic in Alaska than there is anywhere else. And I say that and you look at me, but every cargo plane that actually comes from Asia to the U.S. stops in Anchorage for customs, and so they refuel there. So we cannot supply the amount of jet fuel that they need. The military's up there. There's more air traffic up there than most places, based on the population. So in Southern California, there's heavy crude in California. Facilities are designed for heavy crude, also for the ANS crude. They make gasoline, so they're designed for gasoline. So really, in Mid-Continent Bakken, it's designed for that. So
I'm just gonna take the mouse back. I hate the touchpad. Sorry.
Sorry. So it really depends on our refinery for heavy, light, sour, but we look and we run in what we call an LP model they run almost every day, but they're always looking at what the crude differentials. So within the market, there's pricing that WTI and Brent are your two major crude markers in the world. You buy almost every crude in the world based off those prices. You get a differential. So a heavy crude will be Brent less something, and you compare that against all the other crudes that you have an option to buy. So we look, the flexibility is our waterborne assets can take crude from all over the world. And so we run probably 120 to 140 different types of crude a year based on the pricing and the availability of those crudes. We've never run into an issue on crude availability. There's plenty of crude sitting out there to go acquire. It's just a matter of price. What are you willing to pay for it, and what is it valued versus the other crudes? There are crudes, one crude is not the same as the other. I can produce more clean product from one versus another if it's lighter or has better characteristics in my refinery. So I know what every crude in the world will actually produce in my refinery. So based off that, I know what I'm willing to pay it for that crude versus another. And so we run big linear programs to come up with what are you willing to buy, what should you buy, what did you buy, and how are you going to run it to optimize your product slate.
Okay, I'm going to combine from Houston and West Texas A&M both. We got a similar question here. I'll just read both of them to you. Apologies if this gets a little long-winded. Concerning Mexico, your discussion on Investor Day and in the most recent call focused on the north and northwest regions.
Yeah.
What is preventing expansion south and along the west coast? And if the opportunity were to arise, how feasible would an integrated expansion be into states as far south as Jalisco or Oaxaca? And also, as you expand further into the Latin American market, how do you plan to manage the added risk?
So first of all, from the risk perspective, we're doing it very asset light. So we are working with owners of stations down there, and they brand their stations for us. So it's a very capital light. We're not buying stores. We don't have operations where we have employees down there. We have a few, but not hundreds or thousands of employees in Mexico. The reason that we've only done Northwest Mexico is when they unregulated the Mexican markets, they started in Northwest Mexico. And they opened that up. They bid out the access to the logistics systems. So they opened up their terminals, their pipelines, and we won the contracts in those regions to utilize the tanks and pipelines from Pemex to move our product into the market. They The plan and calendar said they should have opened other markets by now. They have not. The original proposal for Northwest Mexico was delayed by about 6 months, which we think is probably in the other regions is 6 to 12 to 18 months, as they're trying to see what is the impact within Northwest Mexico, because it's most similar to Southern California. I mean, the population goes back and forth. There's not been a big, historically within Mexico, there's been price controls, and so they've stopped that, and they're open. You can open stations, but you have to buy the product from Pemex. Our goal within Mexico is we move our product through our pipelines and terminals to our stations. So it's very ratable offtake, and we're not buying from Pemex. We're actually moving our product. So we have a very different model than a lot of the competitors do, and we'll move into those areas in northern Mexico, Sonora, and once they're open and we're able to hopefully secure pipeline and terminal access.
How about a question here? All right, Dave.
Okay, yeah, I do have more online. And Denver's position in the California market adds both benefits and risks to the company. Will your strategy moving forward be focused on exploiting and defending the benefits or diversifying the risks? And if diversification, which areas do you believe would offer the greatest opportunity for fully integrated operations?
So it is a highly competitive market on the West Coast. We cannot exploit our position on the West Coast at all. I'll be very clear on that one. But within the West Coast, if you were to run, as from a CFA perspective, you've heard of the Herfindahl Index. You can run the numbers and figure out whether we can go buy something else on the West Coast. But it is one market. And we have an asset in every market, and there's a limited number of competitors. So we'd look to, there are some regions in the mid-continent, there's some regions maybe in the Midwest that you'd look at. Our integrated strategy on the Gulf Coast really doesn't fit. A lot of companies on the Gulf Coast, it's very big assets. They sell into a pipeline that takes it up into the Midwest or the East Coast on the big pipelines, and the East Coast refineries, in our opinion, should probably be shut down. So, there are some options out there. We know what they are, but we'd be very selective in what we do.
Anything on the acquisition with Western synergies? Yeah.
There's one other on here that dovetails with that one, I think. Your competitive edge is driven by your selection of location where you are isolated from established competitors. You can do what you want with that. And how would you continue to sustain such an environment?
So all the markets in which we operate are highly competitive. You can access them by water or by pipe typically. But there are barriers to entry. That's when I talk about integration. If you've contracted up all your volumes, there's very few outlets that someone new to the market can enter without having a very big hill to climb. But in most of our markets in which we operate, maybe have 25% to a third of the market share. But there's a ton of competitors out there. But our strategy is to be one of the bigger, within the markets we operate, to have a very efficient refinery with an integrated retail system.
Sure, UTSA.
Yep.
Would you buy a refinery to take it offline?
Potentially, yes. It depends what did it come with something else? I mean, did it come with other assets? What markets does it serve? If you look at, one of the assets that we've acquired over the last couple of years is the Dickinson Refinery in North Dakota. We were given the Dickinson Refinery in North Dakota is probably a better example. or state. The company that built that asset did so over the last 5 years. They spent $400 to $500 million to build it. In the first year, they successfully lost another $100 million operating it. And they came to us and asked us to take over the operations, and we run it much, much differently than they do, or they did. But that's probably an example of, we didn't shut it down, but we're looking at options to convert it to renewable diesel, or we're integrating some of the feedstocks with our other facilities. So we operate that facility much, much different than they did. So yeah, given the scenario, we would look at all opportunities.
Again, Ray from Tamu. With the current political situation in the Middle East, how do y'all plan on hedging the, I guess, political risk?
So from we buy crude globally. They fund, the Middle East currently funds their governments with primarily the money from petroleum and hydrocarbon sales. It's one of those that we continue to monitor the situation, but we don't hedge our risk because we're not dependent upon the price of crude oil. We're dependent upon the demand for products. So if crude oil is shot from $50 to $80 tomorrow, there'd be very little impact on our business. It would change cash flow because working capital would change a little bit, but we generate cash. But it's not one that we can do anything different to influence a situation like that. That's probably a bigger global risk than we have influence over.
So we can probably take 2 more questions here. Dave, if you want to do you have one more online, and then we'll take yours last?
I think I hit everything online. I was just looking back through it. If I haven't hit everything online, let me know if you have a question remaining. I know I have combined some of them. I think the online people can hear me. So just if you have anything remaining, probably one in the room, one online is what's left.
Earlier you mentioned the move away from gasoline towards upgraded gas products. Could you elaborate a little bit more on what types of products you would be looking to move into in the future in the next 10, 15 years as demand for gasoline declines?
Yeah, so probably 7 or 8 years ago when our current CEO got here, his kind of focus was, how do we upgrade gasoline? And we've always thought that the distillate end of the barrel, so the diesel and the jet fuel, would be in higher demand longer term, whether that comes from vehicle efficiency or the EVs. So how do we shift or flex our yields towards distillates? So we've had a lot of projects over the years that do that. And you can flex 5 to 10% just within, with capital projects within the slate of, when I said that metal matches the market, almost every one of our refineries was designed to maximize gasoline production, because historically in the U.S. that was the product that was premium almost every month of the year, every day of the year. So it was one of those, they always maximized gasoline. They didn't put much flexibility in. So we've been looking, how do you put more flexibility in so you're not producing as much gasoline? Then it's petrochemical feedstocks, that the mixed xylenes, polypropylene, the plastics that are used for, how do you take gasoline blend stocks and upgrade them to petrochemical feedstocks, whether they're used on the West Coast or exported to Asia? And they can be more valuable. A lot of them are more valuable than gasoline today. And longer term, you're just taking a market call on what you think it's going to be.
Was there anything
else coming online?
Well, I guess just a last question, just for all the participating teams here. What would you say is the 1 or 2 companies that are the closest comparable to Endeavor?
So the closest comparable is Marathon Petroleum. Within here, you'll see on a couple of slides we talk about peers. We name 5 peers. Holly Frontier, Marathon Petroleum, PSX, or Phillips 66, and then Valero. So Marathon is probably most similar in the fact that they run an integrated business where they have logistics, marketing, and refining. Valero is refining in a small logistics business, but they're very large refining and small logistics. But they sold off their retail business, and then PSX is they have investments, and it's just a different. They own like investments in chemical companies, a couple midstream companies. They have refining globally, and a somewhat marketing system, but it's more of a global company than we are or the other peers are. So, and then Holly Frontier is just a smaller peer. They don't have marketing integration either.
Well, Brian, we're right at 5:30. Any closing remarks? Or you guys, I certainly want to be mindful of your time.
Good luck, guys. It's one of those. I don't want to discourage anybody, but there's a lot of equity analysts, research analysts out there that try to, value our company. They try to model our company. Some are good, some are not. But it's one of those. This is from a difficulty of modeling. This sector is probably a little bit more difficult because it's not the way it's not revenues and growth. It's a margin-based business. So you need to make some assumptions in what you think the margin will be and what impact that margin, the change in the margin could have on the earnings of the company. But just, it's not your textbook case of valuation and terminal value for a company.
But with this competition being here in the Southwest, and we have participating universities within Texas, Oklahoma, and Louisiana, the one thing is probably certain is a good number of us are going to be working in the energy business and energy industry. And so what better way to start to gain more exposure that's there? We know that there's complexity with this company and this industry, but it is going to be a great learning opportunity for you. So utilize your mentors, utilize your advisors, of course work within the rules, within the competition, but this will be a great learning tool for you as you start to transition. You're getting out of school, you're looking for a job. This is going to be great experience. You're going to have a research paper in hand talking to a hiring manager, and this is something that you are going to put in a good amount of time, you and your teammates are, but just a great tool to use when you are in those interviews. So really dive into this company, into this industry, learn a good bit of it. It's certainly going to pay off for you. But we do appreciate all that are participating, all who have come in today. Please drive safe. It's just messy roads out there. So take care, good luck, and we'll look forward to seeing those reports in February.
And lastly from me, again, thank you to Brian for participating. Thank you to John. Actually, he is the co-chair of the Southwest Research Challenge, and for those words, he was a former competitor as well. I actually predate the competition just a little bit myself in age. And what I was going to say is also we will be making this presentation available online. I'm not exactly sure how just yet, so for those of you who are still on that have other team members, be on the lookout for that. But I think as Brian mentioned, as I meant to mention at the top and I did not, we also have on our investor relations website, which of course you all should have found already, but be that as it may, I believe Greg's presentation when he was giving this, our CEO, and the entire executive team that was flashed up there at the very beginning of this presentation, that is an available resource as well, which I would recommend. Thank you for your participation, and the recording will end here.